Saudi Arabia has made its move. They want in on BRICS, the powerful economic alliance that could rival the West. If this becomes reality, it might spell serious trouble for the US dollar and global financial dominance. The Crown Prince of Saudi Arabia, MBS, recently spoke with South African President Ramaphosa and clearly signaled Saudi Arabia's intention to join BRICS. According to Ramaphosa, the Crown Prince expressed a real interest in being part of the bloc, and they're not the only country lining up. If this goes through, it would be a massive shift. It's not just about Saudi Arabia selling oil to more countries. It's about breaking down the petrodollar system entirely. And MBS's request is being taken seriously. At the next BRICS summit, this topic is expected to be front and center. The way things are progressing, it's likely just a matter of time before Saudi Arabia partners with China and Russia to protect their shared interests from Western influence. For those unfamiliar, BRICS is an alliance of 5 major emerging economies: Brazil, Russia, India, China, and South Africa. These countries are economic heavyweights. They produce real goods and natural resources. If Saudi Arabia joins, BRICS could become the most dominant energy-producing coalition on the planet. So why is Saudi Arabia leaning toward BRICS and not their longtime partner, the United States? Because ties between the US and Saudi Arabia have hit a low point. Trust is breaking down fast. Let's go over what's happened recently. First, OPEC Plus decided to cut oil production by 2 million barrels per day to push prices higher and increase revenue. The US wasn't thrilled. The president even warned of consequences for Saudi Arabia, though what those might be, nobody really knows. Threatening the leader of OPEC, which handles about 60% of the world's oil exports, isn't exactly a clever strategy. Saudi Arabia fired back, saying that the Biden administration actually asked them to delay the cuts until after the US elections. The situation keeps escalating. If Saudi Arabia joins BRICS, it would be the first real step toward weakening the US dollar. The dollar is still king because of its strong backing, especially from Arab oil. But if that backing disappears, we might witness the collapse of the reserve currency status and a major financial shakeup globally. So what really gives the dollar its strength? People often say it's because the dollar is the most widely used and in-demand currency. That's true. Over 70% of global trade is done in dollars, and more than 60% of international debt is issued in dollars. But let's go deeper for a moment. The US dollar is a currency like any other. It's essentially a means to exchange value, an IOU, a kind of fancy coupon to buy goods. What made it dominant was an agreement in the 1970s between the US and Saudi Arabia. Oil would be priced exclusively in dollars. This instantly made the dollar the most useful currency globally. Anyone who wanted oil had to get dollars, which made countries stockpile the currency and trade in it. Oil made the dollar powerful. But if Saudi Arabia or OPEC begins pricing oil in other currencies, say the yuan or rupee, the dollar's dominance would take a direct hit. And that's what makes Saudi Arabia's BRICS ambitions such a potential game changer. The US has long reaped the benefits of having the reserve currency. Low interest rates, the ability to print money with minimal blowback, and offload inflation onto the rest of the world. But when Russia got cut off from its dollar reserves through sanctions, Putin scrambled to find alternatives, demanding rubles for gas and selling oil in yuan. Russia was too tied to the dollar-based system, and they paid the price. That's the same system Saudi Arabia is now distancing itself from. They're tired of being treated like a gas station, told to pump more oil on demand. If they join BRICS, it will be a direct challenge to the current world order. It's more than politics. It's a coalition of commodity powerhouses. BRICS countries don't just have financial goals. They have resources. China leads in gold production. India and Brazil are major food suppliers. South Africa brings critical metals. And if Saudi Arabia joins, they add massive oil reserves to the mix, alongside Russia's. Together, BRICS plus Saudi Arabia would control over 32% of global oil output. When you factor in OPEC, which contributes around 35%, you're looking at a group that dominates more than half of the world's oil supply and exports. And remember, Saudi Arabia leads OPEC. Now imagine BRICS announcing oil can be bought not just in dollars, but also in their own currencies, yuan, rupees, rubles. Suddenly, dollars aren't essential anymore. And that's risky for countries holding huge reserves in U.S. currency. Their assets could be frozen or blocked from the SWIFT system under U.S. sanctions, just like what happened to Russia. That's why the dollar's share of global currency reserves is now under 60%. If oil trades in multiple currencies, demand for the dollar drops, and countries will start shifting their reserves toward BRICS currencies. Saudi Arabia, in turn, lowers its exposure to Western financial retaliation. The synergy within a BRICS plus Saudi Arabia bloc would be massive. They'd be largely self-reliant. Food from Brazil and India, minerals from South Africa, manufactured goods from China, and energy from Russia and Saudi Arabia. Now let's talk about defense. This is a major pillar behind the petrodollar system. Saudi Arabia agreed to sell oil in dollars in exchange for U.S. military protection, and crucially, weapons sales. Let's not forget, the kingdom isn't exactly in the world's most stable region. One of Saudi Arabia's biggest concerns has always been Iran. So naturally, they've looked to the United States for defense guarantees in exchange for backing the petrodollar system. But lately, things have started to shift. American lawmakers have been pushing to limit arms sales to Saudi Arabia, which essentially breaks a key part of that decades-old petrodollar agreement. The U.S. wants Saudi Arabia to reverse its oil production cuts, using the threat of halting weapons sales as leverage. U.S. Senator Chris Coons once said that both the White House and Congress are likely to act, with one of the top options being to cut off future arms deals. If you're MBS and you hear that, it's a clear sign to explore other national security options. NATO isn't viable for Saudi Arabia because they'll naturally lean toward the Americans. That leaves BRICS as the most logical alternative. Saudi Arabia's foreign minister, Prince Faisal bin Farhan, told CNN that if the U.S. refuses to provide arms, the kingdom would simply look elsewhere. He stated clearly that Saudi Arabia is always evaluating what suits their technological needs best, and that it doesn't make sense to rely on a single weapon supplier. And he's absolutely right. If you depend on just one country, even if their products are good, you risk being overcharged or completely cut off. That's dangerous. Looking at global arms exports, the U.S. is still dominant at 39%, but Russia and China, both part of BRICS, account for 23%, so Saudi Arabia has real options. Even India is building up its defense sector, aiming to hit $5 billion in arms exports by 2025. America is no longer the only player in the weapons market. With BRICS, Saudi Arabia can explore multiple deals, trade oil for arms, or use currencies like the yuan instead of the dollar. It opens the door to a flexible, dollar-free arrangement. If the U.S. halts arms sales, Saudi Arabia can pivot, and they won't need to honor the petrodollar agreement anymore. Saudi Arabia joining BRICS could mean a lot. They could influence oil prices, reshape global defense ties, and more. But let's focus on what it means for the dollar. If the petrodollar system collapses, the United States economy will feel it hard. Two major advantages that helped make the U.S. a superpower will vanish. First, America's ability to borrow money at ultra-low interest rates will be gone. That means, slower economic growth and reduced consumer spending. The United States is the world's largest consumer economy, built on cheap credit, all made possible by the dollar's reserve currency status, which even currently is under absolute stress. Oil-exporting countries, including Saudi Arabia, recycled their dollar earnings into U.S. treasuries to earn some yield. That led to a global trend, nations buying up trillions in U.S. bonds, pushing yields lower for decades. Just look at the 10-year yield. It's been in decline for 40 years. But once the petrodollar era ends, that flow will shrink. Other countries will reduce their dollar holdings, less money will go into U.S. treasuries, and interest rates will climb and stay high. That means companies borrow less, consumers spend less, and economic growth slows. The days of easy money will be over. The second major loss? The ability to print money with little consequence. This has been the Federal Reserve's go-to tool, printing money to keep the economy afloat. Since 2008, every downturn led to more quantitative easing. Print more dollars, inject liquidity, and buy time. but it comes with a delayed cost inflation. In 2020, the Fed printed trillions, ballooning the balance sheet from $4 trillion to over $9 trillion. Inflation didn't show up right away, but after 12 months, it hit hard, going from under 2% to over 5%, and today, it's sitting above 8%. But here's the advantage of having the reserve currency. You can print and spread the impact globally. Everyone holds dollars, so inflation gets exported. Smaller countries don't have that luxury. They'd face hyperinflation. If the dollar loses reserve status, this trick stops working. The effects of printing money will hit the United States immediately, and the Fed loses its most powerful economic weapon. That's why the United States has fought so hard for decades to keep the dollar as the global standard. But they've forgotten a crucial point. A currency needs something backing it. And in the dollar's case, that backing has been oil. Without it, the dollar becomes just another piece of paper. This is why global shifts like these are so critical. That classic investment advice, putting money in the S&P for a 10% return forever, only works as long as the dollar holds its reserve status. Once that ends, everything changes. No, the United States won't collapse overnight, but it will be put on equal footing with the rest of the world. Mortgage rates will spike. Government borrowing will be tougher. Programs like Social Security, Medicare, or even defense could face cuts. Defaults could become a real concern. We're already seeing signs. Central banks around the world have sold over $1 trillion in reserves this year to defend their currencies against a strong dollar. Japan is dumping, India is selling, China is hedging its bets. Now imagine what happens when the reserve status is lost. Countries will start ditching dollars, some to buy gold, others to invest in U.S. assets like farmland or property. But this flood of returning dollars will drive inflation up and could spark a debt crisis. Demand for U.S. bonds will fall. This is the domino effect we're talking about, and it all starts with the collapse of the petrodollar. Right now, Saudi Arabia holds the upper hand. If the United States truly cuts off arms sales, it might push Saudi Arabia straight into BRICS. We'd then see a surge of bilateral deals, new security pacts, and a step-by-step move away from the dollar. So what do you think? Will Saudi Arabia make the leap into BRICS? Is the United States making things worse by threatening its longtime ally? Drop your thoughts in the comments, stay informed, and don't forget to like and subscribe as we navigate these turbulent times.